What's up guys, and welcome back to the channel. So I've been noticing in the first half of this year that I started doing these consultation calls is that a lot of my target audience is dinks and Henrys. And dink stands for double income, no kids, and Henry stands for high earner but not rich yet. And a lot of you guys want to learn about real estate investing. Typically you guys are the ones who have achieved what I like to call the very first step of reaching financial freedom, the income step. My personal approach to finance is somewhat traditional and simple, and it can be summarized in 3 easy steps. Now, step number 1 is what I like to call the income step. And this step means that you've increased your income to a very significant amount. And my definition of a significant amount means that you are in a very high tax bracket, somewhere in the 32 to 35% tax bracket. This usually indicates that you are paying a lot of money in taxes, and so you're perfect for the strategy that we're going to be talking about in just a bit. The second step in achieving financial freedom is what I like to call the no tax step. And this is the step in which you learn how to pay less taxes on that increased income by investing in the right assets. And last but not least, the third step in reaching financial freedom is the reinvest step. And that basically means taking the tax savings from step number 2 along with the high income from step number 1 and using that money to reinvest into these assets and help you pay even less taxes. Now, if you only get to step 1, the income step, that means that your path to financial freedom is kind of a linear progression. When you implement step number 2 and step number 3 and you save money on that income and you reinvest those tax savings, that's what's gonna get you to grow at an exponential rate towards your financial freedom goals. So with that said, in this video, I'm gonna be talking about one of the best, if not the best, tax strategy for dinks and Henrys, and it's called the short-term rental loophole. I talk about the short-term rental loophole a lot with my tax strategist. So if you wanna work with my personal tax strategist, I left a link in the bio to his website. I'm actually going to be doing a YouTube video with my personal tax strategist, and we're going to be talking a lot about these type of strategies. So stay tuned for that. And if you're new to this channel, welcome. My name is Michael. I'm a software engineer in the Bay Area full time. And on the side, I invest in real estate. I started this YouTube channel because I'm very passionate about helping people just like me, dinks and Henrys, achieve financial freedom faster through investing in real estate. So quick background about me, I was actually on track to pay over $100,000 in federal income tax alone in 2022. But by purchasing enough rental properties, I was actually able to reduce that bill down to about $20,000 and saved about $80,000 in 2022. I actually did not use the short-term rental loophole because I actually was able to claim something called real estate professional status, which is an alternative to this tax strategy. And if you want, you can learn more about it right here. But the reality is that with my approach, it's not so easy to qualify as a real estate professional. So it might not be practical for about 95% of you W-2 or 1099 income earners. So the short-term rental loophole method is equally as powerful as the real estate professional status method, which is what I'm using. But the short-term rental loophole is much easier to qualify for if you're a full-time W-2 employee or 1099 employee. So let's dive into this short-term rental loophole. The short-term rental loophole essentially requires you to do 2 things. Number 1, buy a property and rent it as a short-term rental. And number 2, materially participate in the activities related to that business. So we'll cover what material participation means in a second, but the first step is to go buy a, let's say, $1 million short-term rental. Now, the first thing you have to realize is that your business is going to have both income and expenses. So let's just say that your short-term rental brings in about $100,000 of gross income in 2023. Okay, great. That means that you made $100,000 of income, but what are your expenses? Your expenses are going to include furniture costs, cleaning costs, mortgage interest costs, property tax, property insurance, and much more. But the king of all deductions and the centerpiece to this strategy is a deduction that we refer to as depreciation, but more specifically, bonus depreciation, which is depreciation on steroids. So let's just say for easy calculations that all of the expenses that we referred to earlier total up to about $60,000, not including depreciation. So at this point, our business has an adjusted gross income of $40,000 because it brought in $100,000 of income, but had $60,000 of expenses or deduction. Now, let's factor in the biggest deduction, bonus depreciation. So bonus depreciation essentially allows you to take a full deduction for the cost of any component inside your rental property that has a useful life of 20 years or less. So what components in my rental property have a useful life of 20 years or less? To answer that question, we get what's called a cost segregation study. A cost segregation study is basically a third-party service that you can order, just like an appraisal, and they'll assign a useful life to every single component within your rental property, and it'll assign a value to each of those components. Now that you have this cost segregation study report that tells you what has a useful life of 20 years or less, you're going to total up the value of all of those components, and that is how much of a deduction that you can take in your rental property the very first year that you place it into service, or basically have the short-term rental up and running. So in 2022, my friend did a cost segregation study on his $1 million rental property, and he was able to claim $300,000 of depreciation deductions for 2022. So now let's recalculate the adjusted gross income, but throw in bonus depreciation deduction. Now remember, our AGI for our business was at $40,000. And if we apply a $300,000 deduction, our new AGI is going to be negative $260,000. The whole point of doing this and making our business lose paper on money is that we're going to take that loss from our business and apply it directly against our W-2 and 1099 income. Now hold on for just 1 second, because there's one thing that we need to understand about doing this. In the eyes of the IRS, there's actually two types of income. There is something called passive income and something called non-passive income, but let's refer to that as active income. Now for all W-2 and 1099 employees, your income is considered active income, and let's put that on this side right here. And normally when you start a rental property business, usually that business is considered as a passive business. And a passive business is a business that generates passive income. Let's put that on this side. Now remember, in 2023, we have a property that actually lost $260,000. But because that property is a passive business, these losses from our business are what we call passive losses. And the problem that I'm trying to state is that passive losses and active income do not mix because they live in two different domains. It's like trying to mix oil and water. They just don't mix. So the reason why this strategy is called the short-term rental loophole is because at the core of this strategy, we are trying to convert our rental property business from a passive business over into an active business. So how do we do that? Depending on how you operate that business, you can claim that business as either a passive business or an active business. Now, the benefit to having it be an active business is now those $200,000 worth of losses that come from your active business are considered active losses. And you can use active losses to offset any other form of active income like your W-2 or 1099 income. So the trick with the short-term rental loophole is to be able to prove to the IRS that my rental property business is no longer a passive business, but rather an active business. So here are the 3 rules that you need to follow in order to be able to claim to the IRS that this is indeed an active business. Number 1, you have to have a short-term rental business. You can either buy an existing home, renovate it, and turn it into a short-term rental, or you can just buy a turnkey short-term rental business. Step number 2 is that the average stay of all the reservations made that year need to be less than 7 days. So that means you can have reservations that go for 15 days, but you would just need to have another reservation that stays for maybe 1 or 2 days, and that would average out to like 7 days. And the third requirement to making this business active is you need to materially participate in that short-term rental business. So what does material participation actually mean? So the true definition is that material participation occurs when a taxpayer is involved in a business on a regular, continuous, and substantial basis. So there's something called the material participation tests, and as long as you can qualify or pass one of these tests, then you can claim material participation. So there are multiple tests for qualifying for material participation, but I'm going to give you the 3 most common ones that I see in order from most common to least common. The first test is that the taxpayer did nearly all of the work in that short-term rental business. The number 2 test is that the taxpayer worked more than 100 hours in that activity and more than anyone else. So if you hired someone like cleaners or a property management company or landscapers, then you need to be able to prove that you're working at least 100 hours and more than any one of those people. And that's the main reason why you can't hire a property management company if you want to use this strategy. you need to be materially participating in this activity. And the third test that I see being used most often is if you work in that activity for more than 500 hours. So if you do claim this strategy and you do get audited, you do need to have the correct paperwork to prove that you met these material participation hours. So that's why we have a spreadsheet that tracks basically what you did on what date, how long you did that thing for, and we have like pictures or texts or emails of proof that we were there and doing it that day. And for proving the 7-day average for all your reservations, you can pretty much just collect all of your reservation confirmation emails and average them out. So again, if you have all those 3 things checked off, you have the short-term rental business, you have the average stay of 7 days or less per reservation, and you materially participated, then you now qualify for using the short-term rental loophole, and you can now use that negative $260,000 of losses against your other sources of active income like your W-2 or 1099 income. So now let's say that you are a married dink, double income, no kids, and you made $400,000 in 2023. Well, you can now reduce that number down to $140,000 and report that number instead of $400,000. At $400,000, you would have been paying $80,175 to federal income tax. At $140K, your federal income tax is now $16,336. And that is a difference of $63,839. You will essentially be receiving a $64,000 check from the IRS once you file your taxes in April. That is the power of the short-term rental loophole. Now, out of all the consultation calls that I've had, here are the top 3 questions that I get when I explain this concept to somebody. The first question is, what happens when I sell this property? Now, the biggest downside to this strategy is a concept called depreciation recapture. So simply put, depreciation recapture occurs when you sell the asset that you took a depreciation deduction against, and when you sell that asset, the IRS is going to look back and total up how much depreciation deduction that you've taken on that property, and they're going to require you to report that as income. So if you took a $300,000 bonus depreciation deduction and you sell that property the next year, you're going to have to report on your AGI, on your personal AGI, that your income grew by $300,000. You're going to have to pay it back. So rest assured, there are plenty of ways to not pay depreciation recapture, and I don't ever plan on paying depreciation recapture myself. So if you want to learn a little bit more about that, you can go ahead and schedule a call with me with the link in the description. The second question that I get a lot is, if I claim a large bonus depreciation deduction in year 1, what happens in year 2? And the answer is yes, you will not be able to claim bonus depreciation again. It's a year 1 benefit. But again, the reason why we do that is because money that we have today is more valuable than money that we have next year or in 2 years or in 3 years. So the idea is that we're front loading the benefit of that depreciation deduction so that we can have more money in the form of tax savings this year. And remember, the third step in reaching financial freedom faster is to reinvest the tax savings. So by doing bonus depreciation in year 1, we have a lot of tax savings that we can start to put to work sooner because we have that money today and not next year. So while it is true that you are not going to have as much of a deduction in year 2, the idea is that you can use the tax savings from the first property that you bought in 2023 to go buy a second property in 2024 and do this whole process over again. So the saying goes, buy until you die and never pay taxes. Now, the third question that I always get is that, is bonus depreciation phasing out? And the answer is yes, bonus depreciation is not as effective as it was last year. And let me explain. In 2017 to 2022, when you took bonus depreciation, you could take 100% of the cost of all of the components in your rental property in the first year that you own that rental property. But starting 2023 and every year after, the effectiveness of bonus depreciation is going to be reduced by 20%. That means while in 2022 you were able to claim 100% of the cost of those components, in 2023 you're only going to be able to claim 80% of the cost of all of the components in your rental property that have a useful life of 20 years or less. So there is some urgency and motivation to buy more real estate this year as opposed to next year, because next year you're not going to be able to get as big of a bonus depreciation deduction. But who knows, with the next administration, we might see bonus depreciation come back up to 100%. So hopefully you guys understand the short-term rental loophole now and how it can save you a lot of money on your taxes. It's one thing to understand a concept, but it's another thing to use that concept and plug it into your personal life. So if you want to work with my personal tax strategist, you can use the link in the description. Or if you want to schedule a call with me personally and have a one-on-one strategy call, again, the link is in the description and let's talk. Hopefully you guys take full advantage of the short-term rental loophole strategy, and I'll see you guys in the next video. Peace out, guys.